You're listening to the Scotiabank Market Points podcast. Market Points is designed to provide you with timely insights from Scotiabank Global Banking and Markets leaders and experts.
Welcome to Market Points. I'm Patrick Bryden, Global Head of Thematic and Sustainability Investment Research at Scotiabank Global Equity Research. Today, we're discussing the key ideas in our latest Scotiabank 360 Multi-Asset Investment Ideas Report. What if the oil shock intensifies? Implications for the Canadian economy and beyond. The current U.S.-Israel-Iran conflict has brought oil markets back into sharp focus. We are recording this May 29th, 2026, and as of today, the situation remains fluid. Any resolution, escalation, or change in access through the Strait of Hormuz could shift the near-term outlook. But one of the core points from our work is that oil shocks often last longer than markets initially assume. So to unpack all of this, I'm joined by Olivier Gervais, Director, Modeling and Forecasting with Scotiabank Economics, and Hugo, Ste-Marie, Analyst with Scotiabank Global Equity Research. Gentlemen, great to be here with you, and I'm excited to get into it.
Thanks, Patrick. Great to be here. Looking forward to the conversation.
Nice to be with you.
We begin the report by laying the groundwork and placing our current situation within the historical context. And this goes back throughout the history of oil prices to 1860. What the evaluation of the crises led us to was to basically understand how these things have transpired in the past through 5 basic points. The first is duration, the second is peak pricing, the third is production constraints, the fourth would be spare capacity, and the fifth is inventories. In terms of duration, we bucket it into short, medium, and long-term crises. The short-term crises typically lasted 0 to 2 years, and they averaged about 9 months. Examples of those crises would have been the Suez Crisis or the Gulf War in the 1990s. Medium-term crises lasting about 2 to 5 years, those averaged about 2.5 years. And those included both world wars and the more recent Russia-Ukraine conflict. Long-term crises, these can have durations that are in excess of 5 years. One of them would be the Arab oil embargo of the 1970s. Now, that event only lasted a couple years in terms of supply constraint, but the effects of it were very long-lived, where you had a secular run-up in the price of oil. In other words, you saw a political risk premium priced in that lasted a long time. The second point of peak pricing is to try to understand how far oil prices actually went up from the pre-crisis levels to the ultimate rise in the price tension. And that averages 200% over these 14 crises. Right now, today, the U.S.-Israel-Iran conflict has seen oil prices go up approximately 90%. When we think about one-year averages, they're about 13%. So the conflict that we're seeing right now is pretty intense. The third item that we wanted to focus on was production constraints. So how much of the valve of global oil production has been constrained, so to speak. At the maximum point, the conflict that we're experiencing right now is about 20 to 21% of global crude oil production was physically being constrained. It's not like the Middle East has not anticipated the potential for this kind of crisis. And so there are workarounds that were in place. A lot of them had not really been used extensively in the past, but alternate pipelines, such as in Saudi Arabia and other quarters of the Persian Gulf area, have been able to basically logistically find alternate routes of egress or takeaway capacity. And so what that means is the production constraint today is more like 12 to 16%. So it's less than the maximum we've encountered. But if you go back to the history of all the prior crises, the production constraints were more in the 5 to 9% range. So today is truly significant and unprecedented. The fourth item we tried to peel apart was just spare capacity. And this is just a fancy term for extra production room that exists globally. Often there's higher price production that's sitting on the sidelines that can be brought on, but it doesn't get activated or stimulated until you get that price signal. So historically, we have data that goes back to the 1970s for this information, and the average crises through that period of time to today had about 7% of spare capacity available in the marketplace. When we think about that number today, it's about 5%. But what's really interesting about that is 80% of that 5%, so 4% of the marketplace, is resident within that Persian Gulf area. So it's all basically choked back behind the Strait of Hormuz. There's 1%, so the balance that's available, the bulk of that is in Russia and Kazakhstan. And obviously, with Kazakhstan being Russia aligned and the world being pretty fragmented around this issue, that presents some obvious implications in terms of there being effectively no spare capacity. The fifth thing we tried to really dig into was inventories, and this is a difficult process because inventories are kind of opaque globally. The more you widen out your lens, I would say the less reliable the data gets. There can be a lot of floating storage. We're hearing about ghost ships with Russia trying to avoid sanctions and whatnot, but generally speaking, the market tries to narrow that lens and typically focuses on the OECD inventories. And when we do that, we translate that as what's known as days of inventory or forward cover. And so you're just looking at how much is available in storage that you can measure and how many days of supply would that imply. And that inventory suggests that there's about 57 days of forward supply. So if you were to drain that in 50 days, basically you'd have no OECD inventories. The EIA, the U.S. Energy Information Administration, estimates that those days of forward cover will bottom out at about 52 to 53 days in September, and then see resolution of the conflict and climb back up to about 60 days by year-end 2027. In our view, when we think about that and you plot the Brent futures pricing curve for oil prices against those forecast numbers from the EIA, we kind of feel like that's a best case scenario in terms of a quick resolution actually happening here. So should that resolution not happen, we think you could see more price tension in the futures curve. And if it really got difficult with the inventory numbers, we think that there's a tipping point or a hinge point where it would not be hard to envision $200 oil prices. When you put all the ingredients together, we think that gives a sense for some of the challenges here. On this subject of the potential for significantly higher oil prices, the conventional view is that higher prices are good for Canada. Olivier, your work in the report is fascinating because it goes beyond that simple assumption. Yes, Canada may benefit from higher oil prices up to a point, but where does that start to shift by the negatives of higher inflation and weaker demand? Walk us through how you tackled it.
In general, when oil prices go up, that's a positive for Canada. It's called a positive terms of trade shock, which mean that we get more for the products we export than what we pay for the products we import. So it's like saying basically that there's more money flowing in the country than money flowing out. So when you do get more money like this, you invest more, you hire more people. It's basically a lift to national income. But the issue is that not all oil shocks are made the same. So some are demand driven, some are supply driven. When it's a demand shock, when oil moves because there's more demand or more global demand, it's a clear positive for Canada because there's more demand for oil, but that means there should also be more demand for other goods. So not just oil. But when oil prices move because of supply shocks, well, it's different. Global growth would slow in that case because oil is used as an input to production, and when it costs more to produce stuff, you'll produce less. So that will become partially an offset to the positive terms of trade effect I was talking about earlier. In our macro models, usually this will tell you that even the supply shock will be positive for Canada. It became less positive over the last 10 years, but it's still a relatively small positive for the Canadian economy. Okay, but then the question is it always the case? And that's the question we ask. So if oil is $80, maybe that's one thing, but what if oil is $150? Maybe at some point, the negatives coming from global growth or negative global growth would be enough to more than offset the positive terms of trade. And this is what we ask in this report. In a purely linear world, the answer would be no, there wouldn't be any difference. So to answer this question, I turn to a nonlinear empirical approach that combine a SVAR and a local projection with threshold effects. The first thing you need to do to answer this type of question is to have a method to distinguish between supply and demand shock. Again, those are not created the same. They don't have the same impact on the economy. So it's not enough to simply look at their empirical relationship between Canadian GDP and oil prices. You have to distinguish supply and demand shock. So for this, I use a structural VAR of the global oil market. This is a fairly straightforward technique that's well understood and used in the literature. The idea is to have a model that includes global oil production, oil prices, and oil inventories, and use what's called sign restriction to identify these shocks over history. So you think of sign restriction like a definition of shock. So a supply shock will be one that will increase oil prices, but will lower production and lower global growth, whereas a demand shock will increase oil prices and boost global growth. So at a basic level, you can think of this as an algorithm that will go over history and identify what constitutes supply shocks and demand shocks based on the definition I just talked about. So every quarter, there are going to be some shocks that are going to be identified as demand and some that are going to be identified as supply. So in some periods, like the spikes we saw before the GFC, that was demand driven. While in 2015, it was a bit more of supply shocks, and same thing during the Ukraine war. Okay, so now that we have identified this series of supply shocks, we can now estimate the impact those have on the economy. And for this, I use what's called a local projection. So given the sequence of shocks, we can see how Canadian GDP evolves following a supply shock. So again, this is also very common in the literature now, and it's highly flexible, especially for nonlinear analysis. This is where the threshold comes in. So I can estimate this impact. I can run the local projection over the whole sample, but I can also run it when oil is at a given level. So I can estimate the impact on the Canadian economy when oil is at 80, and also when it's like 120. So in the note, I actually have a heat map that shows the impact on the Canadian economy for each of these thresholds, and we can see when the impact starts to fade. So what do we find? Well, first, good news. Over the whole sample, there is evidence that the economy responds positively to oil supply shocks. In other words, the terms of trade effect is larger than the negatives coming from slower global growth. That's the first thing. But when we start increasing the threshold, we start to see that the relationship fades at around $120. It's not that the relationship really flips and becomes negative, but it's that it becomes not statistically significant anymore. So in other words, we cannot see really the positives anymore. Now, there's a list of caveats that we report in this note. This is actually very important, especially when you do nonlinear empirical work. The first thing is that, supply shocks are not observed directly. You have to estimate this. So, it can be different with other techniques. Also, we're dealing with very few observations when you look at these threshold effects. So that means that it's not like we don't interpret this as a precise tipping point. It's more that there's evidence that the relationship between the Canadian economy and oil prices start to change at around $120, $130.
Hugo, you've looked at oil price inflection points as well in the report, but from a global equities perspective. Let's talk about how you approach that.
Absolutely. Thanks, Pat. So we've been juggling with two main macro scenarios. And I think Olivier's work is very interesting because it confirms and kind of delineate what we initially thought, that is the relationship between oil prices and GDP growth is not linear. It comes to a point where I would say oil prices just simply would destroy demand, even for net energy exporting nations. So I would say below roughly 125 WTI, I think the economy and markets may be able to absorb the shock. Above that zone, I think the risk shifts from what I call a temporary inflation shock to an outright growth shock. Essentially, a very high oil prices scenario, it's regime shifting. So let me walk you through my base case scenario first, and then I'll outline what the tail risk scenario could look like. So in my base case scenario, that's the one where, let's say, WTI prices trade below what Olivier highlighted, below 120, 125, with prices eventually mean reverting lower post-war. If that's the case, I think economic activity should remain quite robust for multiple reasons, including a massive AI capex cycle, which feeds commodity demand. If you add fiscal spending on infrastructure, defense, and a massive wealth effect courtesy of a rising stock market, I think growth is likely to remain strong, supporting the uptrend in earnings, not only in 26, but probably for the next few years. The consensus is looking for S&P 500 earnings growth of around 24-25% this year, followed by another 16% EPS growth in 27 and 13% EPS growth in 28. The TSX in Canada is also expected to deliver double-digit EPS growth over the next 2-3 years. So essentially, that's why we remain upbeat equities, why we remain overweight stocks and underweight bonds at this time. I think in the absence of recession, corporate credit spread can stay tight for much longer, and that's why we prefer corporate bonds over government bonds. In that scenario, I think Canadian equity market and emerging market, including LATAM, should benefit from rising commodity prices and their cyclical exposure, as well as weaker US dollar. So that in a nutshell is our base case scenario. Now, let me walk you through the tail risk scenario. This is, I would say, the least pleasant one, as you described, Patrick. If the oil shock were to last much, much longer and we have what I call a super spike in oil prices, we could get a recessionary oil shock scenario. So in that scenario, you clearly wanna be underweight stocks, as earnings revisions would turn outright negative. As I mentioned earlier, credit spreads are quite tight as we speak today. But if we have odds of recession really spiking, we could see credit spreads widening quite a lot. In that nasty scenario, I would not be surprised to see a US dollar spike. So the DXY as we speak today is around, I would say, 99, but it could certainly move up much, much higher, probably in a 105 to 110 range if we have a real risk in the market, in the economy. And if the dollar spikes at much higher level, I think commodity prices would feel a lot of downward pressure. I think of gold, which historically speaking display a negative correlation with the US dollar, meaning a spike in the dollar would probably send gold prices lower. Would not be surprised as well to see pressure in the base metal market. I think of copper, which could feel some downward pressure too. In the base case, as I mentioned, I think you want to be overweight Canada, you want to be overweight emerging, LATAM, because of the commodity bull market, strong economy. But under the tail risk scenario, you want to shift your regional position quite a lot. I think in that scenario, a flight to quality could benefit the max fund or the hyperscalers in the US equity market, given their weighting in the S&P 500. In a scenario where everything goes down, I think the US could shine a bit more. It could be more resilient given, again, the large exposure to hyperscaler. It would be market weight Canadian equities and EM. As I mentioned, I think the massive spike in the USD would push commodity prices down. So probably a bit more damage here on a relative basis. And clearly Europe, EFI would be maximum underweight. Europe and Asia, as you know, are net energy importers. So if we have a super spike in oil prices, they could feel much more damage, macro damage and equity damage, because the earnings story could be more negatively impacted in Europe and Asia. So this is where we stand. Again, as you mentioned earlier, I think the situation remains extremely fluid. But for now, we stay on the bull side. A lot of uncertainty for sure, but we need probably more visible sign that WTI prices will start to exceed the 120, 125 level that Olivier described earlier.
Thanks, Hugo. And that's a helpful place to leave it. To our listeners, thanks for joining us. And if you're looking to dive even deeper, you can reach out to your Scotiabank representative for a copy of the latest Scotiabank 360 Multi-Asset Investment Ideas Report. What if the oil shock intensifies? Implications for the Canadian economy and beyond. Olivier, Hugo, thank you both for the conversation.
Thank you very much, Patrick.
Thanks, Pat.
Thanks for listening to Scotiabank Market Points. Be sure to follow the show on your favorite podcast platform. And you can find more thought-leading content on our website at gbm.scotiabank.com. This communication does not constitute investment advice or any personal recommendation to invest in a financial instrument or investment research. This communication is provided for information and discussion purposes only. An investment decision should not be made solely on the basis of the contents of this communication. It is not to be construed as a solicitation or an offer to buy or sell any financial instruments, and has no regard to the specific investment objectives, financial situation, or particular needs of any recipient. The information in this communication is based on publicly available information, and although it has been compiled or obtained from sources believed to be reliable, such information has not been independently verified, and no guarantee, representation, or warranty, express or implied, is made as to its accuracy, completeness, or correctness. Past performance or simulated past performance is not a reliable indicator of future results. Forecasts are not a reliable indicator of future performance. Please refer to our legal disclosures on our website.